Hello everyone, my name is Craig Adler. I am a retired certified financial planner. I'm sometimes known as the Angry Financial Planner. I am angry because we do not place enough emphasis on financial literacy. I have started this channel to address that concern. In today's video, I'm going to be discussing with you three very popular investment themes that many content creators are using to create their videos. I am then going to look at the investments that are selected to implement those strategies. And finally, I am going to conclude this video by discussing what most of those other videos have not. And that is the very real and very serious concerns and problems associated with those investment strategies. In order to get started, we need to have a baseline. Today, there is a very basic, very simple, and very effective way for all of us to have captured the very generous returns provided by the U.S. equity market. And that solution was a total stock market index fund. Last year, total stock market index funds earned 17%. For the decade ending in December of 2025, total stock market index funds provided an annualized return of 14%. So what does that 14% mean? It means that if we would have put $100,000 into this investment 10 years ago, those dollars today would be worth $370,000. A significant increase in just over a decade. Even though the returns of the past have been tremendously generous, that does not stop any of us from seeking even higher rates of investment return. One theme that many content creators have noticed, they have noticed that growth investments have provided superior returns to value investments. And that conclusion was correct. When we split the S&P 500 into a growth and value component, what we notice is that growth investments have returned 5% more on an annual basis than value investments, 16% compared to 11%. And that's what you are looking at in the table in front of you. If you want to look at any of this data in more detail, please pause the video at these points in time. Now, one way that these content creators have suggested that we capture this performance difference between growth and value investments is by recommending the Vanguard or the Schwab Growth Index Fund. And it turns out their conclusion would have been correct. Those two funds have earned 17% and 18% respectively. Those same $100,000 put into a growth index fund instead of a total stock market index fund would today be worth either $480,000 or $523,000. A significant improvement to the total stock market index fund. There is still another way that we can enhance our performance even further, and that is by how we allocate our money across different investment sectors. A total stock market index fund can be broken down into industry classifications: healthcare, utilities, energy, and technology. It turns out that technology stocks for this past decade have had incredible levels of performance. In 2025, technology funds earned 22%, and they also earned that same rate of return on an annualized basis for this past decade. What does that mean? It means that if we would have put $100,000 into a technology-focused fund like the Vanguard Technology Sector Fund, those $100,000 today, 10 years later, would be worth $730,000. An incredible performance increase over what we would have experienced from a total stock market index fund. Now, a final way that we can enhance performance even further is by breaking down the sectors into even more detailed investment categories. When we look more closely at the technology sector, we notice that technology is made up out of hardware, software, data and storage, and semiconductors. When we look closely at the semiconductor component of the technology sector fund, that category, that subset of the technology sector has provided life-changing performance. For that reason, a number of content creators have suggested that we either buy the iShares or Van Eck Semiconductor Index Fund. And if we would have placed $100,000 into either of those two funds, today we would either have $1 million or $1.5 million. Those incredibly narrowly focused semiconductor sector funds have provided life-changing performance. The conclusion that a number of content creators have suggested is this: we should transfer our money from value to growth, from broad-based, highly diversified investments into sector funds, and in some cases, we should even consider highly concentrated investments looking at very narrow components of a sector fund like a semiconductor index-based investment. That is the conclusion that many of these creators have suggested how we manage our investments and our financial plans. Unfortunately, these videos have always failed to address one very real and significant concern, and that is the risk associated with these various strategies, and that is what I plan on doing for the remainder of this video. Let me start with the decision to allocate value investments to growth. Today, if you allocate value investments to growth, this is what you are doing. It appears that growth investments are priced at a very high premium compared to value. It appears that value investments are priced at a significant discount to growth investments. What that means is this. That means that in the future, growth investments should have lower performance and value investors should have higher performance. That performance gap should either close or possibly even reverse in the decade going forward. The second factor that is also missed from this discussion of transferring value investments to growth is this. There is a tremendous amount of research telling us that value investments in the past have provided superior rates of return. The data that you are looking at now goes back about 100 years. And when we look at this 100 years worth of data, what do we notice? We notice that value investments have outperformed growth investments by almost 4% on an annual basis. If you are reconsidering allocating value investments into a growth category, you are most likely making the wrong decision at the worst possible time. If you were to ask me, do I plan on doing the opposite? Do I plan on reallocating my growth investments into value investments based on the information that I just shared with you? The answer is no. I don't believe in the style game. I preferred broad-based, highly diversified investments, including the total U.S. stock market index fund. However, If you were to ask me to pick one strategy, either to overweight growth or to overweight value, I wouldn't even have to think more than a minute to make that decision. If I had to overweight one of those categories today, I would be overweighting the value component of my portfolio. The second strategy that we discussed was to overweight the technology sector. This is another strategy I would not implement, and here is the reason why. I believe that the market is efficient. I believe that the market can do a much better job of allocating across investment sectors than I ever could. Today, technology stocks make up over a third of the total US stock market index fund. If I can't reach my investment goals with a portfolio that is already 1/3 invested into technology, I am doing something very, very wrong. The other thing is this: sector leadership continuously is changing. If for the past decade technology led the investment performance arena, most likely that is going to be very different next year and next decade. I realize that I will never be able to determine which sector is going to be the best performing in advance, so why should I even bother trying to play that game? The other thing I need to bring to your attention is this: if you are making these decisions in a taxable account, every time you reallocate, you are just generating a taxable expense. It would be difficult enough to do this without tax consequences, but doing this in a taxable account makes this decision almost impossible. This is the reason I would not play the sector game. And as far as extremely concentrated investments, like the semiconductor investment category that's frequently recommended, I would not even consider that. If you are currently thinking about, or you have currently bought a semiconductor-based index fund, you did that for one reason and one reason only. You did it to chase performance. Let me share this with you. You might end up chasing performance, and you might be right once, you might be right twice, you might get incredibly lucky. You might be correct 3, 4, possibly 5 or more times. But when you chase performance, it is only a matter of time before you step on a landmine. And when you step on that landmine, you are going to blow up your overall financial plan. You are now going to spend the next 10 to 15 years digging out of that hole. I was around in the early 90s. In the early 90s, everyone was saying that the companies that provide the backbone of the internet are here to stay, and they are here to stay for the rest of our life. Some of those companies were Lucent, WorldCom, and Cisco Systems. How did that story end? Can I predict the future about what's going to happen today? Absolutely not. But things are starting to look very familiar today to the way they looked in the 90s. So to me, yes, if you were to play the growth, the sector, or the semiconductor game, there is a chance that you could get incredibly wealthy. The point that I am trying to make is there is another side to this equation that is never being addressed. And that is you are increasing your risk exponentially to the point where, in my opinion, the risk reward simply doesn't make sense. If you do decide to implement these strategies, the only thing I would ask is this: do not do not use 20% or more of your equity money to make these types of investment decisions. Your exposure should be less than 20% of your stock portfolio is allocated to these performance enhancing strategies if you decide to adopt them at all. I really hope you found this video beneficial and helpful. Yes, it is always nice to have new subscribers, but my primary goal is to improve your financial literacy. If nothing else, I hope this video allows you to understand that when you chase performance, you always have to understand how your risk exposure is changing, and does that decision make sense when looked at in a more complete manner. And as always, when it comes to our money, it's always better to be educated than angry.